Most people spend their entire adult life staring at the tax code from the wrong end of the telescope. They think the government writes tax law to tell you what you owe. That is the smallest part of the whole machine. The larger part is instructions. It is the government saying, very plainly, if you know how to read it, I need houses, I need energy, I need technology, I need infrastructure, I need production, I need capital going into places that make the country stronger, richer, and more capable. I cannot build all of it myself. So I am going to bribe private citizens to do it for me. I will not call it a bribe. I will call it depreciation. I will call it a credit. I will call it an incentive. But the message is the same. Build what I need, and I will refund part of the cost. That is the first shift that changes a person's financial life. The tax code is not mainly a bill. It is a capital allocation manual. And once you see that, you stop asking the small question, which is, how do I pay less tax this year? And you start asking the much larger question, which is, what does the government desperately want financed right now? And how do I stand on that side of the table instead of the other one? I have watched people spend decades on the consumer track and never understand why the numbers refuse to cooperate. They go to school, they get a good job, they collect a respectable paycheck, the tax gets taken off the top before they touch a dollar, then they use what is left to pay their mortgage, their groceries, their car payment, their vacations, their subscriptions, their school tuition, and whatever else modern life has figured out how to sell them. If they are disciplined, they save something at the end. If they are unusual, they invest a little. If they are lucky, they retire with enough. That is the default path. It is also the path the code punishes most aggressively. The consumer earns first, gets taxed first, and only then lives on whatever survived the first cut. The owner moves through the world differently. The owner asks where the incentives are. The owner buys what the system wants built. The owner collects the tax advantages first, uses them to build more assets, and lets the assets do the heavy lifting. Most people never make that transition because they keep misunderstanding the mechanism. They hear the phrase tax write-off and think they have found the secret. Usually they have found nothing of the sort. A write-off is not magic. A write-off is simply this. You spent $1 on a legitimate business expense. So the government agrees not to tax that dollar, fine, useful, ordinary, but you still spent the dollar. That is not what I mean when I say the government can help pay you to invest. I mean something much more powerful. I mean depreciation. I mean credits. I mean situations where the code says if you place capital into this kind of productive asset, we will let you recover that cost faster than economic reality would suggest. Sometimes immediately, and in some cases we will lay a direct credit on top of it. That changes everything. A deduction saves you tax on money already spent. Depreciation and credits can turn the tax system into an engine that helps finance the acquisition itself. Once I understood that distinction, I stopped looking at the annual April ritual as a civic beating and started looking at it as a game board. The government has priorities, and those priorities leave tracks all over the code. If Washington wants more housing, housing gets incentives. If it wants more energy, energy gets incentives. If it wants more equipment, domestic production, technology build-out, transmission, industrial expansion, critical infrastructure, those things begin to glow inside the tax law like exits in a dark theater. You just have to be willing to walk toward them. There is another layer that makes this even more important. If I can buy an asset with my own cash and recover part of the cost through depreciation, that is already useful. But if I can buy an asset with borrowed money or with a line of credit secured against another asset and still claim the depreciation or credit on the full purchase price, now I am no longer just saving tax. I am using the tax code to finance growth with other people's money. That is when the flywheel begins. I want you to understand how radical that is. Suppose a man earns a large W-2 income or strong business income this year. He knows exactly how much taxable income is going to be exposed. He knows exactly what bracket he is in. He also knows, if he reads the code through the lens of an owner instead of a consumer, that there may be ways to buy productive assets that generate income, appreciate over time, and simultaneously reduce or offset much of the tax he was about to hand over. The ordinary person thinks in one direction, I owe tax, therefore my money is gone. The investor thinks in the opposite direction. If I am about to lose this much to tax, can I redirect that force into an asset I would rather own? That is how you start moving from survival to strategy. Now, I am not talking about playing cute games with the law. I am not talking about fantasy loopholes. invented by people who have never been audited and think a YouTube clip counts as a tax opinion. I am talking about published policy. The code is explicit. The government cannot create oil wells, apartment buildings, server infrastructure, industrial equipment, energy production, and new systems of commerce at the speed it wants with public capital alone. So it leans on private capital. It says, I will let you accelerate depreciation. I will let you claim credits. I will let you move losses. I will let you offset. I will let you carry forward. I will make this more attractive than ordinary consumption because I need your money working in the real world. Once I saw that clearly, I began to think of investing through 4 engines. Not the only engines, not the entire universe, but 4 engines that make the principle obvious. The first is technology equipment that qualifies for aggressive depreciation. The second is real estate structured in a way that unlocks front-loaded deductions. The third is energy production through resource development. The fourth is solar and similar installations where depreciation can be paired with credits. Each one follows the same deep rule. Buy what the government wants built. Let the code do part of the financing. Keep the asset, let the asset produce. Then use the production to finance the next asset. That is the machine. Take the first engine. Most people hear someone mention computing equipment, miners, servers, infrastructure, and they immediately turn the conversation into an argument about whether they personally like the underlying asset. I think that misses the larger point. The question is not whether you enjoy debating the asset over dinner. The question is whether the equipment qualifies as depreciable property, whether it can be financed, whether it produces something with market value, and whether the economics after tax are superior to handing the same dollars to the government and receiving nothing in return. That is a colder and better question. If a piece of technology hardware qualifies for 100% bonus depreciation in year 1, and if the economics of the equipment remain productive after purchase, then I have something interesting in front of me. I may be able to acquire the hardware, finance most or all of it, depreciate the full qualifying basis, reduce a large amount of taxable income. Now, and still own a producing asset that works every day after the return is filed. That matters. The average person imagines taxes and investing as separate worlds. They are not separate worlds. In the investor's world, taxes are one of the inputs in the return calculation. If I buy equipment for $150,000 and that equipment qualifies for immediate depreciation, I do not merely own equipment. I own an asset, a tax shield, and a future stream of production. If I finance that equipment rather than writing a check out of idle cash, the structure becomes more attractive. I still have to honor the financing. Obviously, debt is not a toy, but the tax attributes arrive as if I bought the equipment outright because the code cares about the qualifying asset and its basis, not about whether my favorite checking account personally suffered emotional pain on the day of purchase. That is the power of the owner path, and then comes the most important part. The asset must not be dead. I am not interested in tax strategies that end with owning a corpse. If I am going to redirect taxes into an asset, I want the asset to produce, I want output, I want cash flow, I want optionality. I want the possibility that the tax savings reduce the economic friction of acquisition, while the asset then goes on compounding in the background. That is when the code starts to feel less like an annual burden and more like a permanent structural advantage. The second engine is real estate. Now, real estate has always been one of the clearest examples of how the system rewards owners, but most people still use it lazily. They buy a rental. They accept the ordinary depreciation schedule. They wait for a slow drip. They collect rent. They hope appreciation does the rest. That can work. It has worked for many people. But if you stop there, you are leaving a great deal of power on the table. The real pivot comes when you understand cost segregation. The ordinary building depreciation schedule spreads deductions over a long period. Cost segregation breaks pieces of the property into shorter lived categories where the law allows faster recovery. Components, fixtures, land improvements, and other elements can be reclassified. Then, depending on the current law and the property structure, a meaningful amount of depreciation can be pulled forward into the early years. For the investor who needs deductions sooner rather than later, that is an entirely different economic animal. Suddenly, the question is no longer simply, what rent does this property produce? The question becomes, what is the after? Tax acquisition cost, once I account for the front-loaded depreciation and the cash flow and the long-term appreciation and the financing structure and the location economics. That is how owners think. Not can I buy a rental, but can I buy the right rental in the right market with the right building to land ratio. Under the right structure, and have the tax code absorb enough of the initial friction that the property begins life with momentum. Instead of drag, I have watched countless people underestimate this. They compare two properties by sticker price, not by after-tax economics. That is like comparing two businesses by logo color. A $300,000 property in one market can behave very differently from a $300,000 property in another market. If one gives you far more depreciable basis and stronger operational economics, and once again the flywheel principle shows up. If the initial tax benefit helps cover the initial equity commitment or reduces the effective cost of entry, then I am not merely buying a rental. I am buying a rental whose first year is partially financed by a tax structure the government deliberately created because it wants housing stock and real-world investment. That is not a loophole. That is the whole point. The government wants doors built, roofs maintained, neighborhoods supplied with habitable units, capital moving into places where people can live. So it gives the owner a better economic path than it gives the consumer. And then there is the third engine, which makes some people uncomfortable because they prefer to pretend the world runs on slogans instead of fuel. The world runs on fuel. Oil and gas have been politically fashionable, unfashionable, celebrated, demonized, subsidized, penalized, defended, and attacked in cycles for decades. But the simple economic truth remains. Modern civilization runs on energy, and the code has long reflected that reality. Resource development has one of the oldest incentive structures in the book: intangible drilling costs, development costs, the ability in many cases to deduct a large portion of investment early, and the continuing income participation in production all exist because the country wants capital flowing into domestic supply. Again, the same pattern. The government needs it, private capital funds it, the code rewards the private capital. I have known people who dismiss this whole category on moral theater alone and miss the deeper point. You do not need to adore every participant in an industry to understand how the tax code treats that industry. If the economics are right, if the operator is competent, if the structure is sound, and if your risk tolerance and liquidity profile fit the investment, the code may make the entry economics far more compelling than most outsiders realize. If a meaningful share of capital placed into a drilling program is immediately deductible because it is treated as intangible drilling cost, then part of the burden you are about to pay in tax can be redirected into productive exposure. What matters after that is operator quality, commodity pricing, project quality, and duration. Those are real risks. This is not fantasy. Any serious investment has risk, but the point of the owner path is not that risk disappears. The point is that the tax code changes the odds. It gives you a running start, and if the asset then produces, the same logic repeats. The tax savings lower the effective cost basis. The production generates income. The asset base expands. Your next year begins from a stronger place than the year before. That is why I keep returning to the word flywheel. The average worker experiences taxes as an annual subtraction. The owner experiences them as a force that can be partially redirected into accumulation. The fourth engine is solar and related energy infrastructure. And this is where the code becomes almost embarrassingly direct. In some areas of policy, the government tries to whisper. Here it practically shouts. It wants private capital to fund installations, systems, and projects that support its energy objectives. So it provides two layers where possible: credits and depreciation. That is an extraordinary combination. A deduction lowers taxable income. A credit lowers the tax bill itself, dollar for dollar. That difference is not $10 trivia. It is the difference between receiving a polite nod and receiving an actual check. If I have a qualifying installation and the credit structure gives me a material offset against tax liability, and then I can also depreciate the remaining eligible basis, the first year economics can become dramatic. Again, not magical, not riskless, not effortless, but dramatic. And because the asset can itself produce value over time through reduced energy cost, revenue participation, or lease structures depending on the specific arrangement. I am left with a fact most consumers never stop to consider. The code was willing to return a remarkable amount of purchasing power to me in year one because I agreed to own something it wanted to exist. That sentence is the key to the whole game. Own what the code wants built. Most people read tax law emotionally. They read it with the exhausted face of a person opening a hospital bill. That is why they miss what is in plain sight. The code is not primarily asking, how do I get money from this citizen? It is asking, how do I move this citizen? S capital and behavior toward outcomes I want. Once you understand that, you stop being surprised by which activities receive favorable treatment. Housing does, energy does, production does, equipment does, infrastructure does, technology build-out does. The code is showing you the national priorities. It is drawing arrows in the dirt. The tragedy is that most people never follow them. Instead, they stay on the consumer rail. They earn, they are taxed, they buy liabilities. They hope promotions solve problems that structure created. Their salary rises, their tax rises, their spending rises, their ownership remains thin, and then one day they are staring at a respectable income and a disappointingly modest balance sheet, wondering how that happened. It happened because the system rewards owners differently than consumers. You do not have to become a tycoon overnight to benefit from that. You simply have to stop behaving as though every extra dollar of tax is an unchangeable act of nature. There are, of course, cautions. I would never tell a sane person to buy an asset solely because it generates a deduction. That is one of the dumbest sentences in finance. A bad asset with a tax benefit is still a bad asset. If the economics after tax are weak, if the management or operator is weak, if the debt structure is dangerous, if the liquidity is terrible, if you do not understand the asset, if you could not explain the investment clearly to a serious 12-year-old, you have no business owning it. The tax code can improve economics. It cannot resurrect stupidity. This is where a lot of people get hurt. They hear the song and ignore the lyrics. They hear somebody say bonus depreciation and stop thinking. They hear tax credit and forget to ask what they are actually buying, what it produces, how long the capital is trapped, what the downside looks like, what the financing covenants require, what the maintenance burden is, and who gets paid before they do. That is not investing. That is tax-themed gambling. The owner path is not a shortcut around discipline. It is discipline applied to a more rewarding track. You still need judgment, you still need patience, you still need records, you still need professionals who understand what they are doing. Because a historian accountant who simply records what already happened is not the same as a strategist who can help you think before you move. You still need to know which activities can offset which kinds of income. You still need to know when a W-2 investor can or cannot use a given strategy, when a short-term rental exception matters, when a spouse professional status matters, when passive limitations matter, when basis matters, when recapture can become a future issue, when a credit carries, when it expires, and when a promising story is really just a salesman with clean shoes. None of that disappears. What changes is your posture. Instead of walking into tax season like a defendant, you walk in like a capital allocator. You ask a different set of questions. What is my projected taxable income? What kind of income is it? What assets does the code currently favor? Which of those assets also make economic sense independent of the tax result? How much capital can I responsibly deploy? Where can financing be used prudently rather than recklessly? Which asset would I still want to own if the tax code were merely good instead of spectacular? That last question saves people from a lot of pain, because if you would not want the asset without the tax sugar, you may not want it with the sugar either. The most powerful version of this whole framework is not the first move. It is the repetition. You redirect a tax burden into a productive asset. The asset produces income or appreciates that output, or increased balance sheet strength supports the next acquisition. The next acquisition creates more tax attributes and more production, and instead of spending the return dollars on lifestyle inflation, you feed them back into the machine. Now, the structure starts compounding. This is how a person with the same top-line income can end up in an entirely different financial universe from another person who earns the same amount, same income, same tax environment, same country, completely different result. One lives on what survives after tax and consumption. The other keeps redirecting part of what would have been taxed into ownership. A decade later, they do not merely have different balances, they have different identities. One is still primarily a consumer who occasionally invests. The other has become an owner who uses the code, the balance sheet, the financing markets, and productive assets as one integrated system. That system is what changes lives. Not the latest hot stock tip, not the latest doom headline, not the fantasy of some secret offshore maneuver. A system, a repeatable system. Read the instructions, buy what the code wants built. Use deductions, depreciation, and credits where the law allows them. Use debt carefully, never romantically. Own productive assets, not dead trophies. And above all, keep the refund inside the machine. That is the part most people ruin. They finally create the advantage, and then they leak it back out through a nicer vacation, a more expensive car, or some upgraded version of the life that already kept them trapped. If you want the government to help finance your investing, and in some cases it plainly will, then the proper response is not celebration. The proper response is reinvestment, because the first refund is useful. The fifth one starts to become serious. The 10th one begins to change the shape of your life. By then, you are no longer thinking like a taxpayer. You are thinking like a builder. And that, in my experience, is the whole divide. Consumers ask how much tax they owe. Owners ask what the tax code is trying to pay them to build. The answer to that question is worth more than most people will earn from a raise, because once you start seeing the code that way, you stop waiting for permission to build wealth. You realize the instructions were sitting there the whole time.